I was talking to a neighbor of mine who knows that I'm a trader, and we were having a discussion about what I do for a living, and he's interested in the market. A lot of people watching this video are probably active traders, and some might be new and interested in the market. And he had a really good question. It's probably the only one that sort of matters when it comes to what you and I do to grow our capital. And he said, do you beat the S&P? And I said, well, the S&P typically returns about 10%, I think, maybe 12% historically, right? There are some years that's far more, there's been years that it's far less, but if you give it time, this is what the S&P is going to yield. And, that's the benchmark. That's what everyone's shooting for, better than the S&P. Otherwise, why not just buy S&P and leave it alone? And you know what? I'll be completely straight up. If someone has zero interest in learning about trading, zero time to spend educating and putting some trades on, I would say, that might sound funny for someone to teach someone how to trade, but if you're not in a position to understand how to trade, be taught, and then apply what you've been taught to the market, just buy the S&P. Okay, I'll be straight up. But if you're watching this video, you're probably a lot like me. You're an active trader of stocks, ETFs, options, maybe even futures, and you've got maybe an active investing life as well. So active trading, active investing. So for me, active trading is things that I'll do on a daily time frame, on a 1 hour time frame, maybe on a 5-minute time frame. And that's going to be my day trading and my swing trading. And I'm never going to stop doing that because frankly, you talk to any good trader, they're going to do a whole lot better than 10% annually if they're good at what they do and they have a sound risk management style. For example, we've got positions in the Sector Secrets Mastery right now in RTX and in Hood. Both of these are closing in on 100% premium paid. So whatever we bought the option for, we're now collecting back when we realize a profit, 100% return on premium. Now, if I can do this enough throughout the year and control my risk, we did this in Hood as well. This is another setup that we had. We paid about $5.90 and $6.10 per option. And as it was going up through 101, we had a target, and that was trading over $12.50. Now, if we can do enough of these types of trades, 100% plus returns, and keep the losses preferably at or below 25%, we can grow an account and definitely do better than the S&P. But this style takes a little bit of time, about an hour a day, and it does take some education. Now, there's another part of my trading life that I probably don't talk about enough. And I did discuss it on Wednesday this week, and some of you caught it, but I want to mention this because whether you learn this process from me or from anybody else, I wish they'd teach us in school. They have to teach us in school. And that is, how do you manage for the long haul? And why is the long haul so important? Well, I used this image in the webinar that I did on Wednesday. And this is the best performing stocks in the S&P over the last 30 years. And it's an unusual list because, I wouldn't expect Monster to be at the top of the list. I think for a lot of traders, things like TJ Maxx caught them by surprise, even O'Reilly. But what I really wanted to focus on is the annualized returns of these stocks over the past 30 years. Annualized, the very lowest stock on this list made 18.7%, and that was Decker's Outdoor Corp. Now, this obviously, well, maybe not so obviously, but you can see at the bottom here, the past 30 years, the annualized return of the S&P was 10.4. So if you can do better than 10.4%, you're beating the S&P. Again, my discussion with my neighbor, unless you've got a goal and a tactic and education that's going to yield better than 10.5% per year, and unless you're willing to spend the time, again, please just buy the S&P. But if you're thinking, Rob, no, I'm an active trader. I love this game. I want to learn the rules of the game, risk management, position sizing, trade selection, and I think I can be, frankly, an outlier. Because most people are not going to put in the time to watch a video like this to educate themselves to say, look, I think I can do better than 10% a year. And most traders will. A lot of traders will do 50, 60, 100, 100+% per year. And you might say, Rob, that's kind of low. It might be, but let's use conservative numbers. Now, on the weekly chart, and that's what I like to use, these are a whole lot easier to identify and more importantly, hang on to, because the element that a lot of traders don't use in sort of this, what I call the microwave brownie mindset of let's get in now, let's get out now, let's make it quicker, 0 days to options expiration, all this super fast, supercharged type trading. One of the things that's lost is the value of time. Can we use time and trend to our advantage? And then probably the biggest lie told that I want to just absolutely crush is this notion that traders can't time the market. So there's two big ideas that I have. One, can you beat the S&P? And I think absolutely there are certain stocks that are going to outperform the S&P. The tactic is, can I find them and do I have the ability to use time to let them do their thing? And the other myth is time, or I shouldn't say myth, but I think the other short side is for a lot of traders, time and timing. We use time to our advantage. And yes, we can time the market. Does anyone think Warren Buffett doesn't time the market? And okay, Rod, you're going right to the top of the mountain. But there are a lot of folks like Warren Buffett. They don't dollar cost average. Not that there's anything wrong with that. But Warren Buffett has a level from which he wants to enter a stock. Oftentimes, he's going to sell cash covered puts until price gets down there, right? Collecting premium until price gets the particular point that he wants to own that company. So that's timing. Anytime we have a particular price from which we want to enter, gang, that's timing. When we don't designate a price, that's usually dollar cost averaging. Now, if you can identify timing, which for me is a dip, now all of a sudden you can start to find positions that can do better than 10%. So you know what? Proof's in the pudding. This is, I don't think it's a complete list, but it's just because I've zoomed it in. There's more. There are more positions on here, but this might be the bulk of the positions that I've built in the Sector Secrets Mastery long-term growth session since I think the oldest position is 2022. Actually, let me just zoom in here a little bit. So 2022, I think, is the oldest position. There we go. I knew there was more there. There we go. So sorry, it's a little small. I was trying to get it to fit on the screen. And 2022 is when we started this session in the mastery. And what this session is once a month, the first Tuesday of the month, I get together with the members and I say, let's look at weekly charts and let's figure out what price we want to time our entries for and then use time to grow. So if you take a look in terms of return and grab some of the 2025 names, because what I'm looking for are names that can have a total return of better than, well, not total return, annual return of better than 10%. And right now, we built Walmart this year, TMUS, let's see. These are all 2025 positions right through here, okay? And it's still only July. I don't want 100 positions in my longer term account. One thing I am a big fan of is keeping it to a very discerning number, usually less than 50. And I've done that approach for almost 35 years, keeping the number of positions I have at around 35 to 50, kind of like Berkshire Hathaway does. It's a good model to follow. And anything underperforming, I'll roll out and then I'll replace with something that's performing better. So Coke, Altria, Nextera, the S&P itself, nothing wrong with owning the S&P itself. All right. Communications, Church & Dwight, AbbVie, TMUS, and Walmart. So what I'm going to ask myself all the time, so let's use this as a cutoff because that's 2025, so I can zoom in a little bit here so everyone can see it a little bit better. So what I want to know is, of those positions that I've got, are they performing at least 10% or better? Now, the year is young, it's only half over, but I can see here that I have a couple positions that are lagging, and those might be ones I might consider cutting to replace with better positions and to put my money to work in an effort to get to and through a 10% return and beat the S&P. But look at the bulk of the positions that I built this year. They're doing better than the S&P, right? Now, you might look at the very bottom here. That is a position I built in September of 2022. So it's not even 3 years old, right? And you can see if I annualize that out, it's better than what? 33%. It's higher than that because since 2022, that's returned 111%. Right? So again, I'm always asking myself, am I finding positions that are doing at least what the S&P can do, if not better? Here's another 2022. In that same time, the S&P would have returned about 30% total, and this is 71. Right? That's the litmus test, gang. So if you're, and not everything is, right? But most things are, and therefore, yes, this portfolio that I continue to build with members, these are all alerts that I sent to members. For the most part, it's beating the S&P, and I'm going to take a good look at things like T-Mobile, Church and Dwight, and maybe even NextEra and say, you know what, I might cut you from the team, right? You may not wear a uniform next quarter in Team Ragi's longer-term growth. So think about that when someone tells you can't time the market, big lie, and think about that the next time you're asking yourself, why am I trading, and what am I doing with my longer-term account growth, where my time horizon is months to years, right? Am I at least beating the S&P? Otherwise, what are we doing here? Yeah, I mean, let's be straight up. So we're going to talk again on Wednesday, this Wednesday, July 16th at 7 p.m. Eastern. And if you caught the first discussion, I talked about shares and the mindset. In the second discussion, we're going to discuss, can you beat the S&P? Am I beating the S&P? And you got a sneak peek here. And then also get into another tool that a lot of traders are using, which is using leaps. Again, this is active investing or active long-term trading. So I'm going to get into even more detail about what we're doing and how we're doing it on Wednesday the 16th at 7 p.m. And you can register for that. And look, if nothing else, you'll get a really good idea of what's possible. And it's a lot like the 4-minute mile. No one did it until Roger Bannister did it. And then all of a sudden the next year, I think, I don't hold me to it, but something like 12 other runners were able to beat the S&P. So when a lot of the greats have already gone ahead of us and shown that beating the S&P is possible, they broke the 4-minute mile. Now it's our job to find how they did it and what works for us. And that's been my whole thing. There's so many managers that beat the 4-minute mile. They beat the S&P on the regular. So I thought, well, if they can do it, I can go run my own 4-minute mile as well. And that's really what we're going to talk about. So you can register at simplertrading.com/long-term growth. And I'll see you on Wednesday, this Wednesday, the 16th at 7 p.m. And we'll get into the tools that I use. By the way, I'm not selling any indicators in this at all. In fact, these are free indicators that are available on TradingView. So no, this is not about, oh, ROG is an indicator. No, it's not an indicator at all. All right. So we're going to get into that on Wednesday, and have an awesome weekend. If you have any questions, feel free to leave them below. I answer them myself, and I will see you all next week. Okay. Be good to each other.